These will be contents that you'll never ever see in your life again. And just do yourself a favor and watch this video completely. So this is going to be a trading masterclass for free, and it's going to be probably a 1 hour video, and we're going to talk about some secrets and high level market tactics of crypto trading. So let's just jump into the video very quickly. And why just me? You can just read it. I'm not going to waste your time. I've done it all and lost over $30,000, and I'm not here to sell you anything in this video. Okay. So let's just go to content. So basically, we're going to talk about should we scalp or day trade and scalping system and rules. And no, we're not going to be talking about those risk to reward things. Just put your risk here, put your reward there, and some basic shit. No, if you already, you should already know the basics and all those things by just going to YouTube. I'm going to talk about which terminal to trade, not the basic Binance thing or the Bybit thing. There are specific terminals that a lot of people don't know, and you should trade using those because that can automate your trading to a huge extent. And then we're going to talk about low risk money methods that you can use in crypto to get your sort of your daily income at a very low risk. And then we're going to talk about hedging, and then we're going to talk about where to learn more stuff, right? Like, for example, which platforms to use to learn more stuff. And then we're going to talk about a from free money glitch kind of a method that is on the gray area. But if you want to do it, just for education purposes, I'm going to talk about that as well. And then it will be an ending note, right? So let's just jump into the video and scalping or day trading. Okay, so I'm gonna be let me just close this. Okay, so all right, so I'm gonna be just straight with you, right? Why do you day trade? Like, let's just look at using probabilities, right? So let's suppose you day trade and you take like 3 trades a day. 3 is just like the maximum that you take, and then you take 3 trades a day. Let's say you make you trade 5 days a day, 5 days a week. So roundabout, you're gonna be taking 3 into 30. You're gonna be taking about 80 to 90 trades in a month, right? So you're gonna be taking 80 to 90 trades in a month. And then if you scalp, you would be doing at least 10 trades a day, right? So it's like more than double the quantity of trades. And then that's about 300 trades in a month, right? Now you'll be thinking that you've heard of all those bullshit nonsense that less trades, having more trades mean you're a bad trader, right? You need to have as much less trades as you can. No, that's actually wrong. And why would I say it's wrong? Well, there's a thing called law of large number. Let me just search it up. So you can go to Wikipedia and it will tell you this. So it's a mathematical law that states the average of the results obtained from a large number of independent random samples converges to the true value. Blah, blah, blah. What does it mean? It means, let's suppose that you have an edge and you have an edge of like 1%, right? So let's say that over the long run, you're going to make 1% profit, or that's your edge. Let's just say that, right? So if you're only going to take like 2 trades a day or like 1 trade a day, and let's suppose you have lost that trade, right? And by losing that trade, it doesn't mean that you're a bad trader. It just means you need more time for your system or your edge to play out, right? And for that to play out, you need to have more trades. You need to have a system where it involves having more trades. So if you're doing day trading, you're gonna have like the first day is going to be a loser, the second day is going to be a loser, third day is going to be a loser, and it does not mean that you are a bad trader. No, it doesn't mean that. It just means that your system needs more time to play out that edge, right? Same way casinos work, that, like, for example, casinos have an edge of like 1%, 2%, 0.5% on their games, right? The first game you would win, or the second game you would win, but they know that over the period of 100 games or 200 games or 300 games, you're gonna fucking lose, right? And you're gonna lose hard because of that edge. And the same way trading also applies, right? And when you will have that 3-day losses, you'll be like, my system is bullshit, right? But no, your system is good because you have a mathematical edge. But for that mathematical edge to play out, you need law of large numbers, and that law of large numbers is only applied when you take more trades. Okay. Sorry. And there's also one more thing, and which is completely common sense and logical, is when you're having, let's say, 80 trades, 70 trades a month, and then you have 300 trades a month, there is going to be a huge difference of compounded profits, right? Like the compound effect that's going to work in the 300 trades is going to be huge in comparison to the compound effect that is going to be work in 80 trades or 70 trades in a month, right? That's common sense. I don't need to calculate that for you. All right, so let me just delete all of this. Okay, one more thing is, by having more trades, I don't mean that, you need to have whatever the system it is, even if it's bad, you just have to take more trades. No, you need to have a good system, right? And by a good system, I just mean that, where your expected value is good. You have an edge, right? You have a positive edge. And then just apply that to do more and more and more trades. Simple as that, right? You can't have a bad strategy and try to do more and more trades. If you have a bad strategy, it will still not work in day trading, right? So just have a good strategy and make it work in scalping, right? So I hope I have logically, answered this question that should you scalp or day trade? You should definitely scalp if you have a small capital, right? Like 1,000 or 2,000 or 5,000 or $10,000, you should definitely scalp. It's mathematically more logical to scalp than to day trade. But of course, there's one con in that you need to manage your emotions and you need to be mechanical about your trades, right? But that's a you problem. That's not a mathematical problem. That you have to actually do that and be mechanical and not be emotional. So, but systematically, scalping is always better than day trading. Now, second number is scalping system and rules. Okay, so there's one thing that is very, let me just delete this. Okay, you have to be patient with me in this video. This is my first time recording a pretty long video, so you have to be patient. But the stuff that I'm going to drop here is going to be absolutely enormous. You're going to learn so much stuff. Even if you're an advanced trader, you still have to watch this video. So, scalping system and rules. Okay, sorry, scalping system and rules. So let's just go and first debunk that is the 5-minute time frame a scalping time frame. No, it's not. It is still day trading or intraday trading. Scalping is, if you wanted to look at from the time perspective, is less than 2-minute time frame is considered scalping. 5-minute is not scalping. It's still intraday or day trading. Okay. 5-minute is still intraday or day trading. Why do I say that? Because let's say you go into 5-minute and then you have like a system in play, like, you have a setup here or whatever trade you have here, and then you're waiting for it to play, right? So it took how many bars it took? It took about 1 hour, 2 hours to play that move, right? For the price to go up. 2 hours. 2 hours is a big fucking time, in scalping perspective. Scalping is just quick in, quick out, It's that. So we have now debunked that. Okay, I don't know why I have this on. Okay, so we have debunked the scalping timeframes kind of a thing. Now let's go to step number 2. It is this thing that people like to play with, right? Like a trader would just place the entry here, and then he would say, okay, this is my stop, and why do I have my stop here? They're not being logical with the stop, right? They're just placing the stop here so their risk reward looks good, which is funny. You place a stop where your idea is invalidated. You don't place a stop just because you want to make your risk reward 6 or 2 or 3, right? That's like if you want to look here and where do you think the stop has to be logical. If, for example, you're buying here, right? The stop has to be logical at around this area because this is the high, right? You have to place the stop here. So, for example, you're entering here, you have to place a stop at around this area, right? Because this is the logical place to place a stop. It is where your idea will get invalidated. You should not place a stop where it just looks good on the risk reward thing, because then you're gonna lose and lose and lose, right? And it's not logical. Okay, Now also debunk, let's just debunk one more thing, which is people think that, with a 1 risk to reward or a 0.5 risk to reward, you can't have a profitable edge or you can't have a profitable system. No, you can. It's just about the win rate and the risk and the reward that you're trying to get, right? So if we are on the 1 minute time frame, and let's just say, let's go to, I have that thing here which calculates the, wait a second, I think this is the one, yeah. This is a good thing that lets you calculate the average profit, or like if your system with that win rate and with that risk reward is profitable or not. Okay, so let's just say that we have 50 trades and we are doing day trading, let's just say, and we have a 1 risk to reward, and then we have an 80% win rate, right? Because of course when you have a bigger risk reward, the win probability automatically gets down, right? And if you have a small risk reward, the win probability actually goes up, right? It's just mathematics. Okay, so here you can see that if you have number of trades is 50 and risk per trade is 1% and the risk reward is 1 and the win probability is 80. So you have an average profit of 36%. Now let's just do one little thing, and let's go to a scalping system and let's have more trades. And let's say we have 500 trades, right? And then you can see here this, so let me just go, okay, I can't do 500. Let's just say that we do 10 trades. So if you have 10 trades, you can see it here, the average, this middle big line is actually the average. So the average is at around $1340, right? So your starting equity gets from $1,000 to $1340. And then let's just do, sorry, let's just do, okay, not this one. We have to do, this is the number of trades, sorry, yeah. So if we do 10 number of trades, so if we do 10 number of trades, our starting equity gets from $1,000 to like $1,053. And then if we do number of trades 50, right, then it goes to like 1340, right? That's like 300% increase from the previous starting equity, right? And then if we increase it more, let's just say we could do 100, then you can see that the number gets to like 1875. The average profit gets to 88%. So can you see the difference of what I said, that the law of large numbers and the compounding effect increases when you increase your quantity of trades, when you get to a system of scalping. So if we had 50, the average profit is 35%. If we had 100, we have the average profit of 88%. That's a big fucking gap, right? That you can have from scalping systems. And that's why I recommended scalping always wins over day trading. Okay, so and then the starting equity is 1,000. Okay, so here what I was proving is you can even have a system where the risk reward is 1 and then the win probability is 80%, because when the risk reward is small, the win probability automatically increases, and then you can still be profitable, right? So it doesn't matter if your risk reward is like 2 or 3 or 1. What matters is how it integrates with your win probability. Okay, so you don't have to worry about like the risk reward, and you don't have to worry that always you need to have 2, 3, 5, 6, 7, 8 risk rewards. It all comes down to what your trading style is and what your personality is. I've seen a lot of traders who trade with like 10 fucking risk reward and they make money because they're patient, right? But I've seen people who actually trade with 1 risk reward or 0.9, 0.8, and they still make money, right? Because they're not that patient, and that's just their style and their personality. So it all depends on you. So I've done on the scalping system and rules, and now let's just get into one more thing. Okay, can you tell me what is the biggest enemy of a scalper? You can think for a minute and then like get an answer in your head. It's not your stop loss is getting hit. No, it's not the stop loss is getting hit. Your biggest enemy in scalping is not the stop loss is getting hit. Your biggest enemy in scalping is the fees that you pay every trade. Because, for example, let's say you pay, a round fees of 0.1%, right? So market in, market out, you pay 0.1% total for a round trip, right? And then you take 10 trades, this fucking thing gets to 1%, right? This is what you're paying. Like, you win, you lose, whatever the fuck you do, you're paying 1%. This is a big fucking number. And when it gets to 100 trades, right, it becomes 10%. So in reality, the biggest enemy to scalpers is not the stop losses getting hit, it's the fees. And if you have a platform where, for example, hypothetically, the fees is like 0, right? You would make money, you would make tons of money, right? With a decent strategy, you can make tons of money. Why? Because you're not paying the fees. You can ChatGPT the shit out of, of the thing that I'm trying to say here, but in reality, the fees is the biggest enemy of scalpers. So don't think that your system is the biggest enemy, or your stops getting hit is the biggest enemy. No, it's the fees. So always choose to, and then how can we actually defeat our biggest enemy? Then you would ask me this thing. Okay, then there are two scenarios through which you can defeat your biggest enemies. One is limit orders. Use limit orders, because in limit orders the fees that you pay is less in comparison to market orders, right? But limit orders also come with their own disadvantage, that they are not guaranteed to fill, right? So you have to properly think and then choose. Now, there's also one more way through which you can have the benefit, like sort of a benefit of market orders, but also pay the fees of limit orders. You're like, how the fuck can that happen, right? That I pay the fees of limit orders, but I get the benefit or a supposed benefit of market orders. Well, you can, and that is called chase orders. Right? And you can, and this is an advanced order type that usually you don't get from the exchanges, and even if you do, you can't have more options to make it more advanced, right? Then how can you have that thing? Well, that brings me to the third to the third point, which is in Silico Terminal, right? So I have created a new account for in Silico Terminal for you guys. So this is basically the original crypto trading terminal. Okay, so this is a terminal through which you can have, like, this thing is big. I can't cover this in the video. You can actually search it up. You can see their documentation and then know how to trade within Silico Terminal. But no, the question that you're asking, it's not paid. It's free actually. And how is it free? Because the commission that you pay to your exchange, like 0.1%, they take a portion of that commission directly from the exchange. They don't take any penny from you. And it's safe completely because the keys that you save are saved locally, okay? So it's not saved on their cloud. So there's no issue on trading on this platform, on this terminal. So it's, you connect your account like Binance through API keys or Bybit or, whatever exchange you trade. And then you can have, and you can do the trading here. Okay, so you can see that, there's an option for Chase. So you can have the Chase limit order set up here. So what is actually Chase? So let me just delete all of this again. So I know that, I'm going very fast pace, or some of the things you may not understand, but it's completely okay. This is not a full course that I'm, doing. That will probably take like 10 hours or 8 hours of thing. So you can use your own brain. You have ChatGPT, the biggest probably, asset in today's time. You can ask questions to ChatGPT about what I'm saying here. Okay, so what is Chase? Basically, Chase means that, let's suppose the market is trading here and you put a Chase sell limit order. So what Chase would do is it would follow the price by a 0.1% difference. So it would actually try to follow the price, and when immediately the price hits your Chase limit order, it would sell, right? So you have the effect of a market order, but you're paying limit order fees. That's what Chase is, okay? So now let's come to the point of the strategy. Probably you're thinking that I'm going to talk about RSIs, EMAs, where like you want to ask where to buy and where to sell, right? What to actually fucking do. Okay, so it again, it comes down to why does the price goes up, why does the price goes down, right? The price goes up not because there are more buyers than sellers. No, always it's equal buyers, equal sellers, right? It's impossible to have more buyers buying than less sellers, because if someone wants to buy $1,000 of Dogecoin, there has to be someone selling $1,000 of Dogecoin, and then the trade will happen and it will get executed. Okay, it's not this thing, it's actually the pressure, right? It's actually the intention. So let's say that you see someone selling here, right? And okay, let me give you a better example actually. Okay, so let's just say that someone is buying here. So yeah, so let's just say that there's bid and ask orders, and let's say that someone is buying here, right? So there's a sell order here, sell order here, sell order here. There's buy orders, buy orders, buy orders. So what will actually happen in the depth of market, or the bid and ask spread, or the bid and ask orders, is why did the price moved up? The price moved up because there were equal buyers and equal sellers. That is true. But then why did the price moved up? And what created that move? It is because there was, from the buyers thing, there were people who were actually very aggressive, and whatever the sell limit order here was, let's suppose there was a sell limit order of $100, $200, $300. Okay, my drawing is very bad. So what will the buyers do actually is they will come up to the limit order, they will fill it, and then immediately fill the second one also, and then the third one also, and then the sellers would see that there's a very high pressure from the buyer side, and then the sellers would actually sell, and then what the sellers would do is they would have small sell limit orders for the price. So then the vol from the upper side, which is the sell limit orders, will get thin, and then that wall will be easy to break, and then the price has this impulse move, because the sellers are scared as fuck, because they see how much intention the buyers have to actually buy, and they're aggressive. So the sellers would actually not place too much of a big sell limit orders. They would actually have, and thus the sell limit book would get thin, thus easy to crush for the buyers, thus the price moving up, and vice versa for when the price is going down. Simple as that. Now, what strategy can you should do to buy or sell? Now let's just come to that. So let me just go to a coin like XRP. Okay, one more thing is you should always scalp high volatility coins. You should not scalp low volatility coins like Bitcoin. Why? Because let's say Bitcoin moves like 0.05% in a minute, right? But the fees that you're paying is fucking 0.1%. So you need to make more money than this at least to be net profitable, right? But if you're trading Bitcoin, which only moves 0.05% on the average in 1 minute time frame, how are you gonna beat this on average? So you need to trade high volatility coins, and there's no problem in trading high volatility coins. You would say that the stop loss is very huge, or that's the problem. Well, if the stop loss is huge or that's the problem, then just have a small position size. Just because the volatility is high, the small position size will balance that. So that's not a problem. Okay. Also, where to find high volatility coins? You can find it by going into Screener. This is a free website again that you can use, and what I do is simple as I just click this, and then it will show me the 5-minute volatility of the highest coins, and then you can see there's NMR, EOS, blah blah blah. So you can have this also, and they also have a terminal, but I don't recommend their terminal. The best terminal is this in silico terminal. So okay, I have cleared a lot of things, but we have still not finished the scalping system, right? Like which scalping system at least I use to scalp. So I'll just quickly go over it. Okay, so the scalping system that I use to trade is DOM, so depth of market. And for DOM, I would recommend you. I would post some links on the description that you can actually see those videos. Those are from other creators that you can see, and they have actually very beautifully told about what the depth of market is and how you can trade it and how you can use it to trade. So I would recommend to watch those videos. And also the second way that I trade is very fucking simple. I just go on a 200 tick chart, and what I do is I just scalp the support and resistance, right? So for example, this is a support, right? So I would trade the support and resistance. So let's say I take a trade here and it goes wrong, right? The idea gets invalidated, then I would reverse the trade immediately. And also how to reverse the trades immediately, in Silico Terminal provides that option. And also you can use your hotkeys in your keyboard to trade very quickly, because timing really matters, not only in SEX, but in trades as well. So for example, if you're a normal trader, what you would do, your stop loss would get hit, and you'll be crying, and then you will be like, okay, fuck it, right? I'm not gonna trade anymore. But if you're a real trader, you would see your idea getting invalidated, and then you would see immediately to reverse that trade, and then boom, profit, right? So it's as simple as that. So just trade the support resistance of tick charts. Why do I prefer tick charts? You can ChatGPT that, because like, okay, let me just simplify it. Why do I trade tick charts? Okay, sorry. Tick charts actually represent, for example, if there's like, if I choose a setting of like 100 tick chart, that means each candle actually represents 100 trades that actually happened. So tick charts show you a granular version of the market, which the time charts don't show you. The time chart, like look at this move, like what does it show you? It shows you nothing. It's bullshit, right? Look at this wick. What does it show you? It shows you nothing. The way to look at data through time frames, it is absolutely bullshit. You have to see it through the tick charts or like Renko charts, right? But tick chart is pretty good for scalping, and you can ChatGPT it. Why am I saying that? But I showed you what tick chart is. So for example, if I have 200 tick chart, then it means each candle here represents 200 trades, right? So in this candle, 200 trades happened, and that those 200 trades actually were bullish. So it shows me the market at this time was actually bullish, not like those time frames charts, okay? So two systems that I use: simple support resistance, 200 tick chart, and if my idea is invalidated, I just reverse. There's also one more system that you can use for scalping, which is the scale side orders. So what the scale side orders does is, let's say that the market is trading here, right? And then you would see that there's a support around this area, right? And then what it would do is you would place a scale side order. So it would put 50 orders from here to here, and you would get an average entry price at around this area. So if the price comes to that zone and then goes up back again, which happens a lot of times, what will happen is you would still be profitable, right? Some of your trades will be active and you will make money, and then you can do that again and again and again until you get all of your orders filled, and that would be your main trade that you actually at first position wanted to execute. So this is also a huge nugget that I'm throwing away here. And again, please, whatever I'm saying, just think upon it. I'm really serious here. You have to think upon it. I'll give you one more example, okay? Let's say that the price was trading here and you placed a scale side order. So you have your orders from here, from here to here, right? And then the price actually pumped, and then it came back down, and then you can take a lot of your trades in profit and get out. Or you can do it again, and then the price came up, and then it came down, and then you can take your trades out of profit. So it gave you two chances to get in profit. That's the power of scale side orders. And then when it actually hit your main trade, it filled all of your trades, and then your main trade got activated. Then again you got in profit. So in the three chances you got profitable. It's simple statistics, right? So I highly recommend to use scale side orders. And yeah, so I gave you the scalping setups. And now let me just drink some water and then I can come back to you. Okay, so it's okay, it's about low risk money methods. Okay. So what are some low risk money methods that you can actually do? The low risk money methods is number one. What you can do is you can have two scale side orders. So one, you can have okay, let me just tell you a little secret. Okay, so you go into ATR and you have 1 minute time frame, and then you see that the ATR actually tells you that the average volatility that has been the highest is actually wait a second, you go to the highest one in the recent time, it is actually 0.0042. So 0.0042 is the highest volatility, right? So this is like a low risk money making method that you can use for daily, and have it automatically set up in Silico. So 0.0042, what you will do is you will place a scale side orders from here to here, 0.0042, or like here, right? And then you can also have a scale side limit orders from here to here, right? And to be on the double safe side, you can actually go in the 15-minute time frame and have the ADR. What is the ADR here? So the ADR is actually the highest has been at around 0.017. So 0.02, let's just take it 0.02. So 0.02 is this, right? So you can have the scale side from this to this, and from here, wait a second, from here to here, 0.02, right? And why are you taking the this percent of gap? Because that's what the ADR tells you, right? ADR knows the volatility of this asset in this time frame. Then you can have this set up in Silico, and it's gonna be easy, right? So you don't have to trade directionally, you're trading non-directionally. You're actually betting on the volatility, you're not betting on the price. So this is one money making method that you can use. It's similar to grid trading, but it's not actually grid trading, because in scale side limit orders, you can also set your size distribution. So you can tell in Silico that do you want more of the bigger position sizes to be on the lower side, or on the middle side, or on the upper side. So that is different from grid trading. If you come here, that's grid trading. It's not grid trading. Okay. The second low risk money making method is actually options. So again, trading is like a business. You have to treat it as a business, and then only you can make profit off of it. Okay, so let's just go to BTC. Okay, BTC. So low risk money making method is actually you sell. Let's just go to a bigger time frame, like 1 hour. Okay, so what you do is you think about BTC, because BTC has options and that those are very liquid. So let's just say that for me to buy BTC, a very good option is actually this price range, 107,513, right? I'll be like, okay, if a BTC comes to this point, I'll buy. It's a good support area, it's a good discount area. I will try to buy it. But we don't know if BTC will come here or not, and we don't even know how much we have to wait, and we don't even know if it even will come or not, right? So what you can do is you can sell a put option here. You can sell a put option, and let's say that you sell a weekly put option here, and that would give you, like, let's say $100, right? That's a credit to your account. And if BTC doesn't comes here, you'll have that $100 credit. If BTC goes up, you have that $100 credit. If BTC remains in this range, you have that $100 credit. And if BTC comes to this point, you have that $100 credit. But then you would have to buy Bitcoin here, right? But that's your main trade idea. So this is like, a no-brainer kind of an idea that you can sell options and make money, okay? But for that you need to have at least of a $5,000 bankroll to do this kind of trades. So also you can do, like just Google a cover call selling, or put option selling. You can ChatGPT it. I'm just giving you guys ideas and how I make things work. Okay, so now it comes hedging. Okay, this is an interesting topic, and this is probably gonna make the video a little bit longer, but I'm gonna stop this video and then come back because I can't speak anymore. I have to do something else. I'll come back to you very soon. All right, so I'm back from the short break, and okay, so now we're gonna be talking about hedging. So there are two types of hedging that you can do. Number one is through futures, or like the perpetual contracts, right? So let's suppose that you have a trade. Okay, so let's suppose that you have a trade that is a buy from here, right? And you the normal way to get out of trades is just to close the trade in profit. So to use take profit, right? But there's another way that you can do is through hedging. So let's suppose that you have bought Bitcoin here, and you can apply this concept to any time frame that you want, right? I'm just doing on 1 hour time frame, but you can apply it to any on any time frame that you want. So let's say that you have a buy trade here, and instead of taking a profit and closing this trade, what you do is you think that I want to secure my trade, but I don't want to close this trade of buy trade because I think that this price that I've bought is actually very rare, or is very good point through which I've bought. So what you would do is you would do an equal sell position at this price when the price comes here, right? So when the price goes down, your buy trade is still there because that's what you want to hold for long term, but your short trade here, which you have sold, actually makes profit. So this would make profit, and this would reduce the profit because the price is coming down to your buy entry. So this would be like locking your profits, but then again the price from this point actually again goes up. So in this point of the price going up and then down and then up, you actually made profit from the short trade in extra. So this is one style of hedging that you can do, is to do this. And for example, when Bitcoin was at around 29,000 a few years ago, what you could have done is you could have actually bought Bitcoin there, and then you would be like, okay, this is a great buying point that I've bought Bitcoin. I don't want to lose this entry price that I've actually bought Bitcoin at, but I think that Bitcoin, when it will reach 32,000, it will go down for a little bit. So at that point, you can actually have a short position of equal size or of a less size, and you can have and you can make profits through that as well, through hedging. And for example, this would of course mean that you are locking in your profits, and if the price goes up and up and up, then you would have that net locked profit as there, because then the short position will be having a loss and the buy position will be having a profit, and then when you subtract that, you will be having the same net profit. So to mitigate that, what you can do is the opposite position that you're opening as a hedge, you can have the position size smaller. But then the disadvantage of that is if the price goes down, then if the price goes down and down and down, then the hedge won't be able to protect you 100%, right? But then to mitigate that, you can have a stop loss for the buy side and not for the sell side when it's going down. Because if the price goes up, you don't have anything to worry because your buy position is bigger than your sell position. So this is the way. You have to think logically, you have to think pragmatically. And I just showed you how to mitigate things, how to defeat your enemies and do those things, right? This was number one way of hedging. The number two way of hedging is actually, it's unconventional, but some people still do it. It is, they would open, let's suppose they would open a buy and a sell at the same time, same price, same position size in the asset. And then, for example, if the price goes down, let's suppose it went down and it broke the support, then they would close the they would close the buy side and they would keep running the short side, right? So that's one way of hedging, but it's unconventional and I don't recommend it. But still, if you think that you can get an edge through this, you can still do it. And then there's a third way of hedging, which is sort of martingale, and I still don't recommend it, but still, if you want to create your own style of this hedging, you can do. And if you have an edge in that, kudos to you. So the third way of hedging is basically, let's suppose that you buy here and then the price goes down, then you would actually have another trade as a hedge, but this hedge will be of a bigger size, and then you would short a bigger size, and then if the price goes down, you will be in net profitable. But the problem with this hedging style is if the price ranges, so if the price goes down and then it goes up again, and then you would have to have another hedge, so you would have a third trade which is bigger than your last trade, and then if the price goes up, right, so then you would still be net profitable, but if the price again goes down, then you would be in loss, in net position. So the problem with this hedging style is it works if the price is not too rangy, it's not ranging, or it's not like in a box, or it's not weird, then this hedging style actually is very profitable. Okay, the second category of hedging is through options, right? You can actually do hedging using options. So let's say that you have a buy position of one BTC, right? You have a buy position of one BTC. That means that your net delta is positive 1. It is positive 1, right? Then to hedge your delta, which actually is your position size, like not technically, but you can still say that, what you can do is you can find option contracts that have a net delta of -1. So you have an option contract of -1, you have a futures contract or a perpetuals contract of +1, then ±1 is actually net delta gets 0, right? So you're hedging using this. Options hedging is a little bit advanced. You would have to learn about options trading and etc. But if you have a good capital, I would highly recommend you to learn options trading. I would just, just learn that thing, okay? Do yourself a favor, learn options trading, because options trading is much more better than perpetual trading in a lot of ways, okay? So I will also put in description some links of other creators of other videos that you must watch. So because I'm thinking just about you guys and girls, so I just want you to be a better trader. And okay, so where was I? Okay, so we have covered hedging, and then it comes about where to learn more. So to learn more, there are only 2 platforms where you should learn about trading, and where actually people teach stuff that is advanced, like this video. One is YouTube, right? Second is Twitter, but I'd recommend Twitter more than YouTube, and you have to follow the correct people in Twitter as well, and you can know that by spending some time on Twitter, like spending a few weeks, and then you would know which people to follow on Twitter. Okay, and now let's talk about Profum's free money glitch. Okay, so I don't recommend this, but I'm just saying this for educational purposes. So let's just say that you buy a challenge account of like you buy a Profum account, an instant account of like $1,000, right? And you have $100,000 in your capital for that Profum. But in reality, most of the Profums are like a drawdown of like, let's say 4%, right? So $100,000, 4% is like $4,000, and then you buy another account through your friend or through through another Profum, and then you have a 4% drawdown there as well on a 100K account. That is $4,000 again, right? So what you can do is you can have 2 Profum accounts, and then you can have a long and a short. So you buy and sell at the same time, same price, same asset, and then one Profum account will obviously lose, right? And you will lose the $1,000 that you had invested, right? The fees that you had paid, because the $4,000 is your drawdown maximum, and the $1,000 is the only thing that you pay out of your pocket. So technically you have risked $2,000, right? And then let's say that in one account you make like $8,000, right? So you make $8,000, and in one account you have hit your maximum drawdown and that account is gone, right? So in reality, you have only lost $1,000 that you invested in that platform, but in the other side, you've actually made about 8 grand, and then you minus your, you minus your fees that you had paid for both of those accounts, which is 2 grand. So 8 minus 2, it is 6 grand. So 6 grand you made no matter what, right? So this is a thing that you can do to make free money out of platforms. And there's also one more style to this, which is you can actually not buy 2 accounts. You can only buy one platform account and then hedge that trade with your own personal account, right? Like with Binance or whatever. And the platform that I recommend is actually Breakout. They have good Trustpilot reviews and they're pretty good, but you can do your own research and then find good platform accounts. So this is a free making money method through platforms, which is literally a money glitch if you think in that perspective. And then an ending note. Okay. In an ending note, I would say, first of all, you can follow me up on Instagram here. I've just started to post things, and so this is my ID. You can follow me up. And secondly, I would say is just be curious, man. Just be curious. Use like, just be curious. Search about different things. Just have a mindset that there's always learning, and think before you whatever you do. Like have a strategy, and by having a strategy, I mean plan things out, and just treat trading as a business. I would say that's it. And yeah, that's what I would say. And it was really good to make this video. And to whoever who's watching this video, I really wish you well in your trading journey. And yeah, thank you for watching this video. And don't forget to follow me here, okay? Because I will not be posting too much videos on YouTube, but on Instagram I will be active. Thank you. Bye bye.